Leaving Canada? Here's what you should know about the Canadian departure. Tax leaving Canada permanently may come with more than just emotional farewells. It can trigger the single most significant tax event in your financial life: the Canadian departure tax. This tax, formerly known as the Deemed Disposition Tax, applies to individuals who cease to be Canadian tax residents. Unlike a typical tax bill based on income earned, the departure tax is based on the assumed sale of your assets at fair market value the day before you exit the tax system. The impact can be considerable and, without proper planning, unnecessarily expensive. This article outlines how the departure tax works, how to determine your tax residency, and how you may reduce its impact. Whether or not the departure tax applies depends on whether you are a resident for tax purposes. This is not determined by citizenship, immigration status, or number of days spent in Canada alone. The Canada Revenue Agency, CRA, uses a fact-based test based on your ties to the country. There are two types of residential ties: primary ties, significant residential ties, having a home in Canada, a spouse or common-law partner in Canada, and dependents who live in Canada. These ties generally result in tax residency. Secondary ties: bank accounts in Canada, Canadian driver's license, credit cards, memberships in Canadian organizations, and a Canadian mailing address. While individually less decisive, a combination of these may lead to a determination of residency. Other factors include your frequency and duration of time spent in Canada, and whether you have established a new place of permanent residence abroad. To be considered a non-resident, you must generally sell or rent your Canadian home, move your spouse and dependents with you, close Canadian financial accounts, notify the CRA of your departure. You must also establish tax residency in another country. Canada does not allow tax statelessness. The departure tax is not a penalty for leaving the country. Rather, it is a capital gains tax based on a deemed disposition of your worldwide assets immediately before you are no longer a Canadian tax resident. In practical terms, this means Canada will pretend you sold everything the day before you leave. You are taxed on any gains, even if you continue to own the asset and have not realized any cash. Deemed disposition rules apply to most capital property, including shares in public or private corporations, interests in partnerships, cryptocurrency, real estate, with exceptions, personal use property worth over 10,000 Canadian dollars, e.g., art, collectibles, mutual funds, ETFs, and other investments not held in registered accounts. Certain assets are excluded. Canadian real estate is not subject to deemed disposition, but remains taxable when sold. RRSPs, RRIFs, and TFSAs are not taxed at departure, but are taxed upon withdrawal. Assets inside registered pension plans are usually not taxed at exit. The tax is calculated based on the difference between the adjusted cost base, ACB, and the fair market value, FMV, of the assets on the day before departure. Formula: departure. Taxable gain equals fair market value minus adjusted cost base. For example, you bought shares for 200,000 Canadian dollars. On departure day, the fair market value is 350,000 Canadian dollars. Gain equals 150,000 Canadian dollars. 100,000 Canadian dollars. Lifetime exclusion applies. Only 50,000 Canadian dollars is taxable. The tax rate applied is the capital gains inclusion rate, currently 50%, multiplied by your marginal tax rate. You must report the departure tax by filing a final Canadian tax return. In addition, you must submit the following forms. Form T1161 lists all reportable properties over 25,000 Canadian dollars fair market value on the day of departure. Form T1243 calculates gains from deemed dispositions. Form T1244 applies if you intend to defer paying the departure tax. These must be submitted by the standard personal tax filing deadline, usually April 30th following the year of departure. Yes, in certain cases, you may defer the departure tax by providing adequate security to the CRA. This applies to assets with illiquidity or when immediate sale is impractical. Deferral allows you to pay the tax when the asset is actually sold. Security must be posted if the tax owed is above 16,500 Canadian dollars or 13,777 Canadian dollars in Quebec. Interest may accrue on deferred amounts, and conditions vary depending on the asset type and amount of tax involved. Leaving Canada permanently involves more than just packing your bags. It requires careful financial planning to navigate the departure tax effectively. Understanding your tax residency, knowing which assets are affected, and strategically minimizing tax liability can help reduce the financial burden. While Canada imposes a deemed disposition tax on many assets, options like tax deferral and pre-departure planning can lessen its impact.